Hi everyone, welcome back, hopefully with a tea or a coffee in hand. I've got my fellow panelist on stage with me in the studio, and I've got my colleague Ed Blain joining us from London. Ed is a member of the European investment team. He's previously worked as a political advisor, quite interesting. We'll get to that a bit later, his previous life. Ed has a MA Honours in History from the University of Cambridge, and I'm joined by Varshan. Varshan is a portfolio manager and an equity analyst. Varshan manages the Frontier Fund, equities carve-out, and he's been with Allan Gray since 2014. So let's get right into it. I'm going to ask the panelists to keep the questions short and sharp, the answers short and sharp, as there are many questions streaming through on the feed. Varshan, I'm going to start off with you. Our biggest underweight position in the portfolio, relative underweight position, has that been a good decision? Has that been a bad decision? Has it added? Has it detracted from our absolute performance in the balance fund specifically?
Thanks, Saleem. So MTN has been one of our biggest, if not the biggest, underweight position on a relative basis. And over the last year, it has contributed. And over longer periods of time, it has been a contributor as well. So there's a few drivers of that. The first is the asset realization program. So MTN had a number of initiatives similar to global mobile network operators to realize value for shareholders. One was doing a sale and leaseback of their towers, which we thought was just switching bank debt for lease debt. Another was to unbundle their stake in IHS towers, and the market value of that company has reduced quite significantly since it listed. And another part of the business that investors were very excited about was the mobile money operation. So this year we've seen a business called Wave Mobile Money enter quite a few of their markets and reduce pricing materially, lowering the profit pools. And another headwind which they face is a large part of the value of their business is the operations in Nigeria and Ghana, and especially in Ghana, that currency has depreciated significantly versus the dollar and versus the rand. So that's taken its toll on MTN, and the share price has been quite weak over the last year or so.
Thanks for that. Question for Ed. Ed, while the recent performance of the equity fund looks promising, I think we'll all admit the longer term performance hasn't been that great. What's the prospects looking forward? Any comment, Ed, from your end?
Thanks for the question, and great to join everybody. I think that it's always hard to predict what's going to happen next, but it can be simpler to focus on what's just happened. And here we're really talking about what happened 2.5, 3, 4 years ago now in the Orbis fund, which was a period when value performed worse relative to growth than in pretty much any other periods that I can think of in living memory, frankly, apart from 1999 and the peak of the TMT bubble. And that period was very tough for Orbis Global, made tougher by our exposure at the time to some markets such as China and Russia relative to the US, which struggled as the Nasdaq got stronger and stronger and as the world cooled on emerging markets. So that was a very painful period, which I'm glad to say we see the early signs of being behind us. This year so far has been a year of pretty pleasing performance for us, back to more like what we would like to see over the long term. But we've certainly reviewed the decisions we made at that time, learnt our lessons, and we can never say never again. But I certainly hope that it was that was the one-off, rather than the other much longer periods in Orbis history, which have been much more pleasing.
Thanks, Ed. Question for Varshan. Glencore. There's a lot been written on MoneyWeb recently about Glencore, bribes in the mix, ESG issues. We see coal price coming down. Do we still prefer to own Glencore, or are there other diversified commodity companies that we prefer to own?
Thanks, Saleem. So Glencore is still our preferred diversified miner, and there's a few drivers of that decision. So the first is the commodity mix. As you mentioned, Glencore has exposure to coal and base metals, which we prefer to iron ore, which is the main commodity of a competitor such as BHP. Also on the valuation, Glencore trades on lower multiples of spot free cash flow and on normal free cash flow if we use our normal commodity price assumptions. So it's on lower multiples versus BHP and Anglo American. And also on ESG, Glencore is the sort of stock which I would classify as an ESG improver. So you mentioned there is litigation and various court cases which they are working through at the moment. And they have laid out very clear plans of how they plan to run down their coal mines. And I think for all stakeholders, it's much better to have those assets in a listed vehicle as opposed to a private company, as there's much better sight of how those assets are being managed. And it's easier for all stakeholders to hold the operators of those assets to account in a listed setting.
Interesting perspective.
Just on the bribery and corruption allegations, I think it's important to highlight that this is not new news. So this has been in the kind of news in one way or another over the last 5 to 10 years. A lot of it pertains to activities that happened in the early 2000s, but the cases are what's being seen in the market today. So they've already provided for it.
So it's priced.
It's priced in, and I think also importantly, we do think the culture has changed. So that's also an important question to ask.
Great. Rory, I'm going to stick with you. I've got a great question from David. David posted this question while Cameron was doing the update. It's about size, that the Allan Gray Balance Fund restricts it from investing in shares outside of the top 40, making it a proxy for a balance fund index at about 3 times the cost of an index fund. How do you generate alpha within these limitations? So let me just say, I'm posing this question to Rory because he's the guy that picks the shares.
Yeah, so I mean, I think it's important to highlight that first and foremost, we want to be judged after fees relative to our peers and relative to the average. And I think our track record has demonstrated that over time we've consistently outperformed the average manager after fees. And we've achieved that. Actually, when I joined the firm, Allan Gray, our look-through equity exposure was around 4.5% of the free float of the JSE. That's lower today than where it was in 2008. So if we were able to pick mid-cap and small-cap shares back in 2008, that's even more true today. And if you look at the makeup of our portfolio, certainly in the top 10, you see some of the larger names in the top 40. But if you lower down in our portfolios, there's any number of small and mid-cap stocks where our clients collectively own between 15 and 20% of those shares. And I think even within the top 40, one is able to differentiate materially in terms of which shares you own and which shares you don't own. So Varshan spoke just a little bit ago against MTN. It's one of the biggest shares in the index. Another one is Richmond, where we're materially underweight.
Thanks for that, Rory. I'm going to go over to Ed now. Ed, it's interesting, the US inflation numbers came out and it was like a dead cat bounce, and the markets predicting that inflation has peaked and the Fed will take its foot off from the petrol. And what's your view on this, and how are your portfolios positioned for this environment?
So it's certainly true that the market got pretty enthusiastic last week, it's an understatement, on a small improvement in the inflation numbers. And it's great to see an improvement in inflation numbers. No investor likes inflation. It's one of the most effective taxes on investors of all kinds around the world that there is. So the less of it in the long term, the better. I do hope that this is the beginning of the end of inflation running away from the Fed. That said, the reason that inflation will come under control is because people believe that the Fed has the determination to keep inflation at around 2.5% over the long term. And that determination means, by consequence, the determination to cause recessions when needed to keep inflation down. And that's what we're seeing at the moment. We're seeing aggressive hikes in interest rates, which have a 1 to 2 year lag on their impact on the real economy, and so haven't even been felt yet. So we are pretty cautious about the prospects for the US and by extension the world economy over the next 1 to 2 years, because the recent hikes are likely to cause a significant slowdown, if not a recession, at some point in the next 1 to 2 years. And although valuation multiples have come down over the course of this year, which is why the global index has fallen. EPS estimates for the next year or two haven't really moved materially at all. Wall Street analysts, on average, are not predicting a recession in the next year or two, even though history says to us that it's really pretty likely at this point. So that's not a great combination, I think, for future returns, and keeps us more cautious than not, focusing on value and downside protection rather than any short-term upside pop. But it's certainly good to see that perhaps the worst of the inflation is beginning to be behind us at this point. Touch wood.
Thanks. Ed, I'm going to stick with you. I mean, we're living in a world that's becoming increasingly polarized, given the delicate relationship between China and the USA. So how's Orbis thinking about the portfolio? How's the portfolio positioned? And where are you finding pockets of value in these countries?
So it's difficult. It's difficult for us, just as it's difficult for South Africa. We see ourselves as global investors, and therefore when two large parts of the world, in the form of the US and China, slowly fall out, it's easy to feel caught in the middle and forced to pick sides where you don't want to. I think that's just life in the modern world, unfortunately. And the US represents for us a far more reliable source of law and order and a deeper pool of high quality companies run with high integrity. So that's where we would look over the long term if we're ever forced to choose between the two. And we are finding value in the US at all parts of the market cap spectrum. Now, after those significant falls that Rory talked about, the likes of Google, Alphabet, for instance, look really pretty attractive to us. And within the US, which is by far the world's broadest and deepest market, down in the mid-cap space, we are finding a variety of attractive companies of all sorts in niches that wouldn't jump out to you from an index, but which are well run and decent value. Then comparing that to China, we get much cheaper prices again, but that's combined clearly with much greater risk, both in terms of the risk that our investment will be taken away from us at some point, either by the Chinese or the US, frankly, government, and risk that tensions between China and the rest of the world make it harder for an offshore Chinese investor like us to carry on owning those shares for the long term. So there are places where we are attracted by that risk return trade-off, but we're cautious not to be meaningfully overweight China because I do think that the risks are significant.
And I'm going to put you on the spot. 2-3 shares in the US market that excite you most, that you own in the portfolio?
So to give you two completely different examples, on the one hand, Alphabet, everybody knows it. We're in the middle of a global advertising recession, or the early stages of it. The share price has come down materially, so have estimates. It seems to us, just on the multiples alone, to be really pretty cheap, broadly in line with the market. Once you adjust for the cash position and for the loss-making cloud division, which is unlikely to lose money indefinitely. But with great long-term opportunities as a de facto monopoly on most of the world's eyeballs on search. Then looking in a completely different place, Rory talked about energy, and we have a broad spectrum of energy holdings, some of which are all around the world, but some are in the US. The likes of Kinder Morgan, which supplies oil and particularly gas pipelines and owns them throughout North America. The likes of Schlumberger, by far the most important company if you're aiming to exploit a new shale well or most forms of oil and gas drilling around the world, they are the people to go to. Those kind of companies, which will in the very long term need to change their business models, are in our view so cheap that that's more than factored in. The free cash flow yields at the moment are sufficient that they can pay a significant amount of that back to shareholders at the same time as pivoting the business for the long term. So two completely different ends of what's often perceived as the value growth spectrum, both looking pretty attractive to us at the moment relative to the index in the US.
Thanks, Ed. Varshan, question for you. Property market, listed property, has it run its course? What's your view?
Thanks, Saleem. So we continuously assess the REITs listed on the JSE, and we do have a few small positions where we are seeing value, but we still have a very small allocation to the sector, and there's a few reasons for that. One is the loan to value, or LTVs, are still quite high. For the SA focused REITs, I think it's in the high 30%. And the capitalization rate or discount rate, which is used to value those properties, is still quite low versus its historic peak, and also versus the rates used to value unlisted companies. So that discount rate could increase and LTVs could go up. And also on the distributions that those companies can pay, we think there's still room for those to come under pressure for a few reasons, including rates and taxes are going up, utilities, the cost of utilities are going up, and the funding costs are going up. So most of the SA-focused REITs have about 80% of their debt hedged for about 3 years or so. But once that period has expired, they will face higher funding costs.
Thanks. Over to you, Rory. It's a share that we owned. We loved the share, and we fell out of love with the share. But Sasol, what's the view going forward?
Well, I mean, we're not completely out of love with Sasol. We still have a relatively big position in our client's portfolio. But I think maybe it's something we should probably talk to the history a little bit of our holding in Sasol. So it was a big component of our top 10 for the better part of the last decade. With the benefit of hindsight, it wasn't a good investment coming into the COVID crisis. They were kind of in a perfect storm, and that they'd just undertaken this massive project in the USA, entered COVID with an elevated amount of debt as the project was ramping up, and there was, with the benefit of hindsight, an insufficient margin of safety for a business with their track record. So where is it today? They've been able to massively reduce the debt. Some of that has come at the permanent impairment of capital, in that they've sold off 50% of the cracker to LyondellBasell at a much lower price than what it cost them to build the cracker in the USA. But if you look at the business today, now roughly 45 to 50% of the earnings are directly offshore in Europe or the USA, much more chemical businesses than the traditional coal to gas business. And then domestically, increasingly important, I think, to South Africa, both from a power perspective. So they generate around 50-60% of their own power needs. They're importing gas from Mozambique, and they could be one of the solutions in the kind of evolving PPP story in South Africa. But even ignoring that, at spot petrochemical prices, spot earnings for Sasol are around 60 to 70 rand a share. So you're buying it on around 5.5 times earnings today. There are still risks. Over the long term, it's been a very capital-intensive business, and they're probably likely to persist to be capital-intensive, but we do think it is cheap at this point in time.
Thanks, Rory. So not completely out of love. We've got 3 minutes left, 2.5 to 3 minutes left. Varshan, favorite share in the portfolio? I'm going to go around, Ed, Varshan, and Rory. Just 30 seconds.
Okay, so one of my favorites on the SA shares is Ichal Chao. I like it because the founding family has a large stake in the business. It's an extremely well-run business. Whenever there's excess capital, they pay it out as special dividends, and they delight the customer. They continuously improve their business, and I think that's what you want to see as a long-term shareholder.
Rory?
So that's a really double-edged sword to ask someone what their favorite share is, because invariably they're blind to the risks, and that's why they like it so much. So you should probably ask them what their second favorite share is. But nonetheless, I'll give it a go. So my favorite share is one Varshan already spoke to. I really like Glencore. I think the market fails to appreciate not just how important some of the other commodities in Glencore's life are. So they've got significant exposure to coal, in which they're probably generating unsustainable super profits at the moment. But more importantly, they've got significant exposure to cobalt, copper, zinc and nickel, which are 4 of the commodities that are going to be incredibly important to us as a society if we are to transition to renewables, and demand for those is going to have to grow 2-3-fold over the next 30 years. And that's not at all in the price. Today you're buying Glencore on around 5.5 times spot free cash flow.
Correct. So it's a decarbonization story. Ed?
Hey, I hate the question as much as Rory for the same reasons. I try very hard not to have favourite shares, but I'll give you one of my.
The one that gets
gets
you most excited.
Oh, you're making it harder. I'm just going to stick with one of the favourites, and it's one that's close to home in the UK, B&M, which is a British discount retailer that we know well, and I like it for 2 reasons. It's a high quality business and it's very cheap. It's a high quality business. It sells everyday food food for your cupboard, non-fresh food, at a price that's 15%-ish cheaper than the supermarkets. So it's a great place to buy branded groceries if you're on a budget, cheaper than anybody else for the stuff that it sells. And it also sells non-food things like electronics or DIY materials or garden kit or toys for less than Amazon and less than anybody else. Again, because it has its own supply lines to the Far East, and it has a very disciplined, small assortment of what it offers. So it's a great place to go for value for money, and because of that, it's been taking share for 20 years, and it ought to take share just as much in the future as people are feeling squeezed and are looking for a bargain. And because the global investing community is pretty pessimistic on the UK at the moment, it's been focusing on Rory's lettuce. The shares of all UK retailers are available at very low valuations at the moment. B&M selling for less than 10 times earnings, and those earnings have historically translated pretty much entirely into cash. So you get a cheap business that's well above average quality, in our view, with a good management team. That's just one of the ones we like at the moment.
Thanks, Edward. Don't flip back into politics, Edward. Stay with us. So I want to say thanks to Rory, thanks to Varshan, thanks to Ed and to Tamron as well. That's the end of our session today.